Hello and welcome to Outlook 2026. My guest today is Vivek Paul, who is the Global Head of Portfolio Research at BlackRock Investment Institute, joining us from London. Vivek, thank you very much for joining us today on ET Now. To begin with, Vivek, we are in a uncertain time, or 2025 would be a year of disruption, starting from the way Trump went about doing tariffs to the way global central banks are reacting to the global trade. What is your assessment of 2025, and how do you see 2026?
Well, firstly, thank you so much for having me. You're right. 2025 was a remarkable year. And I think some of the things that we saw in 2025 will continue to be a feature in 2026, but the magnitude may be different. So what do I mean by that? I mean that 2025 was a year where really we saw these global megaforces transform the global economy. Right? So it was less of a story about sort of traditional cyclical drivers. It was more of a story about structural dynamics that are changing the global ecosystem, which have implications for America, for Europe, and of course, for India. So you've highlighted some of them already. The idea of the geopolitical backdrop kind of rewiring fundamentally. What does that mean in terms of 2026? Now, our view would be that there's likely to be greater stability in 2026 relative to 2025, and that is probably a force for positive in terms of the region in India. You also talked about the idea of the rates path and the uncertainty around that. And that's one thing I think will continue to matter in terms of 2026. And I think we're going to see more of a divergence internationally with regards to the policy path. You always expect a difference between emerging markets and developed markets to some degree, but I think it'll be interesting to see how that starts to kind of vary even further. So as I look to 2026, I think the continuation of 25 is the idea that these global megaforces dominate. And I've talked a little bit about geopolitics already. I think one thing that I think is particularly relevant to India and the outlook in India is the idea of the future of finance evolving. India really is at the epicenter of this. It's at the forefront of this. It brings more and more people into the financial ecosystem. And that's part of the reason why I think, despite recent cyclical weakness, when we look at the structural dynamics in India, it's a case to hold above benchmark weights when it comes to Indian equity.
Interesting. You said that. Geopolitics always had an influence on the way markets have moved. But trade was for the first time, or tariffs were for the first time were brought in as I would say, a big factor in the way flows are going to go about in global markets, especially to the emerging markets there. Do you see tariff debate to continue into 2026, given the fact that not many countries have signed on so far, including India, and there is a Supreme Court ruling pending in the US, and that would again take the entire narrative of tariffs going into the first half of 2026?
Yeah, so you've touched upon some really interesting points. I think the idea of this continued uncertainty around tariffs in terms of the domestic ability to enforce them, and also the international kind of landing zone in terms of the trade deal struck, then that will be something that could continue to weigh on sentiment, on businesses kind of having clarity in terms of the investment plans they wish to deploy. I think the base case would be that we have greater certainty. I remember actually when we kind of look back on April of 2025, I think with the benefit of hindsight, maybe that was peak uncertainty globally. Now, it doesn't mean that that's a sort of straight line down, but I think it does mean that 2026 should be one where we see less of an impact from the dynamics you're talking about. So, as you say, we don't have exact clarity as to when certain trade deals get signed, but the expectation and the noise that we're hearing, I guess, is that that would be a sooner rather than later thing. And the more that markets feel reassured that that's the case, the more markets feel reassured that whatever disruption that has caused in the past is kind of a in the rear view mirror thing, the more ability for the domestic economy to regrow and to kind of buck the cyclical recent downturn that it's seen. So I think in summary, yes, the thing to watch out for if we're thinking about risks to the kind of core view would be that there's a continuation and elongation of some of the uncertainty we've seen. But I don't think that's the base case. I think the base case is that we see greater resolution in the short order, which means that 2026 is a story where we're looking back on this as a major source of disruption.
Interesting, because if you look at how the currency markets are are reacting to this, or for that matter, how the commodities are reacting to this, is totally different in that sense. Trade is creating an issue with respect to currency, depreciation, especially in some of the emerging countries. The U.S. currency is also, getting weaker against some of the other currencies as well. And from a commodity point of view, oil continues to be, subdued, despite the fact that the Russia-Ukraine war continues.
You're right, and I think the ability of anybody to kind of foresee the kind of end of conflicts is limited, right? So I think it's hard for us to kind of draw too much certainty around that dynamic in particular. But going back to the broader point on currency, you're right. This has been a year, 2025, in which the US dollar has depreciated somewhat meaningfully, and that's raised questions more broadly as to what role does it play in the global ecosystem on a go-forward basis. And we're pretty firm in this view that we do not see anything shifting the US dollar's central role in the global ecosystem. That will continue to be the case. And two things can be true at the same time, right? You can have an element of near-term comparative expensiveness that needs to kind of follow some sort of a broadly cyclical pattern, but that doesn't mean that the structural role it plays is any different. And I think that's what we've seen in 2025. More questions being asked, but I think clearly now markets are settling on the idea that this is something that is not a forever thing. We would kind of see that it's pretty broadly neutral view for us on the US dollar on a go-forward basis. And then when it comes to the implications for particular currency pairs, such as the Indian rupee or any other, I think there it really comes down to some of the aspects we were talking about earlier, right? What is the progress on those trade dynamics? What is the progress on, some of the things that mattered in 2025 and hopefully matter less in 2026? Because again, going back to the point I made right at the start, historically, traditionally, you might think that there's a sort of cyclical macro element underpinning all this. You might think that maybe because the Federal Reserve is starting to cut interest rates or continue that interest rate path, then as a result of that, that has certain natural implications for the dollar, such as weakness, that has implications for emerging markets. And those traditional playbooks are the ones that I'd query more in this environment. I think those are dominated by those megaforces that I've talked about. So I think really this is all about the way in which some of these megaforces transpire. I would anticipate that the slide that we've seen in the US dollar is not repeated in 2026. It's more of a kind of neutral, weak kind of view to start with. And then in terms of the rupee, yeah, we've seen, I guess, a little bit more of a fluctuation than the past. But in general, as a relative story to other emerging markets, the Indian rupee is, I think, a little bit more stable, right? It's a little bit more supported by the fact that external debt is a comparatively small share of GDP. It's a little bit more supported by the fact that the domestic kind of funding sources for businesses is strong, and as a result, less reliance, I guess, on overseas in some ways. So to my mind, I think the kind of relative currency stability in India relative to others is a force for a cyclical rebound to start to come to see at some point in 2026. And also, I do not anticipate a continuation of the trend we saw in 2025 when it comes to the US dollar.
If you look at the foreign investors, they've been net sellers this year, more than $18-19 billion of net sales which have come in. And they continue to be net sellers on a daily basis. And despite that, the markets have been holding on because of the domestic inflows which are coming in. How do you see foreign flows moving from here on? Because towards the beginning of the year, or maybe a couple of weeks, till a couple of weeks back, you had the AI trade which was driving global markets, especially the US markets, and India was seen as an anti-AI trade, which was because of a very less dependence on AIs or AI products, which in that sense. Do you see flows going back to emerging markets, especially like India, where AI is there in form of some of the services and is getting developed rather than being in product and and platforms.
Yeah, so the headline answer to your question is yes. I think over the course of the coming years, I do anticipate foreign investors to, continue the trend that's a multi-year trend, I guess, of greater investment in India. Like you rightly say that the 2025 story, and going back a little bit further, has been one of outflow. But the size of the numbers you're talking about, in the grand scheme of things, are comparatively small. I would view this in a slightly different framing. I would view this as, despite the material uncertainty around the policy path in terms of trade, etc., as you rightly say, the equity markets are broadly held up. I think what that tells me is at a point at which we see greater clarity, the signing of trade deals and so on, then that frankly unleashes a little bit again the idea of domestic growth and therefore the idea of foreigners wanting to be more part of that. And when it comes to the AI story, it's a really interesting point. And when we've been formulating our broader global outlook, one of the things that we've talked about is this idea of, for a global investor, beware of a diversification mirage. What do I mean by that? I mean the idea of just investing in something that isn't the dominant trade just to spread your bets around, right? That I think doesn't make much sense. And indeed, if you were to have been purchasing the equally weighted US equity index rather than the market cap weighted, you'd have lost out a lot because clearly the AI trade did well. What we say instead is, when it comes to diversification, really pick those regions, those countries, those exposures where you think bottom up there is a strong reason for positive growth, which might have a different driver. And that is what I would think when it comes to India. So when I think about this sort of strategic horizon, in part because of the dynamics you've talked about, because it's less of a direct AI beneficiary, well, actually, this is part of the diversification trade here. Like, it's not just not investing in AI stuff. It's investing in something that has an independent source of likely future strong earnings growth, an independent source of likely strong future returns. The idea of foreign investors, as I say, coming back. So I think that story is one that started to take hold. I think that will continue to take hold over the course of the coming years. I say years because I think it's very hard to kind of time the very near term, right? We have seen some cyclical weakness. I would anticipate maybe that would continue. But many who are kind of investing in the stock markets do so not just with a next week or next month focus, they do so with a multi-year focus. And in that context, I think it's hard to look beyond India as a source of potential attractive returns that are diversified from the same core drivers, right? This is a region, a country that's on course to become the third largest economy in the world in the course of this decade, and yet it makes up, a couple of % of global equity indices overall. There's a mismatch there. This is something that I think is a structural opportunity, and as you say, as we framed in this question, has some natural diversification benefits, as well as independent sources of alpha and return generation, which makes it attractive for foreign investors in the future.
How do you look at in this backdrop some of the sectors like IT services, because they have been the I wouldn't say battered, but one of the underperformers for the year, nearly 20% underperforming the benchmark. How do you see the future for Indian IT services then?
So look, I think first thing to say is that the traditional models of doing business in IT services in across the board are going to have to evolve, right, in ways that we are still learning how they need to evolve. I think the market reaction that you're referring to is based upon the idea that if those continue to be the ways in which the traditional business models are the ones that persevere into the future, then something has to give. But I don't think we should assume that that's automatically the case, right? This is a story for India. This is a story for the global ecosystem, that we would anticipate that there is an element of moving with the new technology, leveraging the new technology in different ways. So I think the first point to make is we'd expect that there's going to be disruption across the board, not just in one particular sector, but also the pace of adoption matters, right? You see this in a bunch of different mechanisms throughout the global ecosystem. Different sources of energy demand have come to the fore, renewables, etc. but it also has meant that, traditional sources of energy still play a fundamental role. So I don't think we should kind of extrapolate materially from the near-term reaction. I think we can say that if business models don't change, then maybe the market reaction would be justified and continue, but I'd anticipate those business models to change. And then more broadly, when it comes to sectors that we'd call out, I think we've talked a little bit about financials already. I think that is an area to watch in India. Financials is one whereby, again, to my earlier point, more and more people kind of being brought into the financial ecosystem, the other technology, the UPI technology, the ability of bringing millions and millions of more people into the traditional financial system, the idea that liquidity is probably likely to improve, the idea that credit conditions are likely to kind of get easier as a result of likely central bank rate cuts. These are all things I think that could, provide a strong background for financials. So I think the big picture is we should anticipate that AI is a disruptive force in the global ecosystem. Net, that's probably a positive for India for the reasons I mentioned before. The ability, I think, to be somewhat insulated in the main. But yeah, we should anticipate that traditional business models will evolve.
Give me a sense of the valuation picture here, because we started the year with a valuation of 21 times forward earnings. We continue to be at the same kind of valuation, and there's a time correction which is coming in with earnings growing as well during this period of time. Do you still see India to be overvalued compared to other emerging market countries?
So I don't, and I wouldn't personally take that framing of it being overvalued. I know why people say that. People say that because they look at the traditional valuation metrics, they compare it to the past and notice that it's higher. And, simplistically based upon that, of course, it looks expensive versus the past. But I think there are a few things that we need to kind of flesh in to tell the fuller picture. The first point would be that the path, as we've just talked about, of domestic rates is lower. All else equal, if we were to see lower rates into the future, lower interest rates into the future, all else equal, that supports higher valuations, just kind of mechanically and numerically. The second point to make would be that the earnings growth picture, for some of the reasons we've already talked about, I think is likely to be a little bit more robust. And we would anticipate that, as I said, with the uncertainty unwinding, we'd see a greater ability for domestic companies to generate strong earnings growth. You take those two things together, and the way in which we think about valuations, more looking at, a risk premium lens, kind of controlling for that rates path and controlling for the future earnings prospects, I don't see Indian equities as materially expensive. And as a result of that, I would take the other side. I would say that, look, I can see why traditional valuation metrics look a little bit elevated. I don't think that's the full picture. And I think for anyone investing over a multi-year horizon, actually, we will find that valuations will continue to appreciate over that period of time for the reasons I've mentioned. And as once we kind of get through this nearer term cyclical dynamic, I think we're going to see a positive story as foreign investors come back.
If that is the case, what would be, or which are the sectors which you think are, would be the favorites going into 2026?
Well, I talked a little bit about financials already. I think that's an area that I think it is worth watching. I think manufacturing in the context of the global rewiring that's occurring, the fact that traditional supply chains are shifting, and India is able to play a role in the middle for the US relative to China, and also kind of other areas. I mean, you just look at exports, I guess, in this most recent period, and of course, relative to the United States, they went down a bunch, but it's not the case when you look at Africa, when you look at other parts of the Middle East. You look more broadly internationally, and India is able to kind of demonstrate that it can increase its trade footprint in other parts of the global ecosystem. So I think the point here would be that manufacturing as part of a global rewiring is an area to look at. Financials I've already talked about, and then more broadly infrastructure in a country that still is rapidly growing. And there's a huge amount of productivity benefit that can occur as a result of infrastructure being upgraded, and that's a major kind of a path of the policy on a go-forward basis domestically. That is also something I think that all the affiliated sort of sectors and companies associated with that build-out should also find room to prosper.
We spoke about equities, Vivek. What about gold and silver? they've been outperformers of this year. Do you see this run-up continuing in 2026?
Yeah, so they absolutely have. I mean, these are two of the sort of standout exposures one could have held in 2025. I think the ability to forecast these assets in particular is even harder than it is to forecast anything else. Now, from our perspective, the idea of gold as a differentiated source of return is one, to my earlier point about diversification mirage, is one that for many people will play a role in portfolio. But I think it's more in the context of, the traditional diversifiers not necessarily doing what you'd want them to do. So, long-dated United States Treasuries, for instance, historically have played a strong diversification role, gaining in value materially when there's a global risk of sentiment. For some of the reasons that we've touched upon in our conversation, the idea that the fiscal picture looks a little bit different in developed markets than it does in the past. I would anticipate that those traditional diversifiers don't do quite what they did. So, I think that as a result of that, you can see why people have been kind of going into to gold a little bit more. I think on a go-forward basis, it's hard to make a strong claim that you'd see the same performance in 26 as you saw in 2025, because in part, the performance of these assets, gold and silver, was to do with some of the uncertainty that we saw in 2025, which, to the points I've made throughout this discussion, I don't anticipate to recur in quite the same way in 2026. So, net, I would say that yes, it plays a role for some who are a little bit more wary of those traditional diversifiers, but I think I would view this as a shorter term sort of tactical trade rather than a structural allocation that we'd kind of persist with forever, because obviously this is not an income generating asset. When you have income that you can generate from bond yields generally being higher, then the opportunity cost of holding it all else equal is greater, right? So I think the structural case for it is not one that I would be advocating materially, but as a nearer term sort of tactical exposure, I can entirely see why people would continue to be interested.
Yeah, my final question to you is, there are two global events that could happen in 2026. One, a conclusion of the Russia-Ukraine war, which peace talks are underway for that. And second, amicable resolution to the US tariff war, which is going on. If both of them comes to amicable solution, how will the markets react, and what could be the way equities will perform?
So with those two things in isolation, I mean, the general point to make is markets love certainty, they dislike uncertainty. So if we have resolution in those elements, in any other elements when it comes to geopolitics, markets will react positively. Why? It's because businesses who might be holding off investment decisions don't need to hold those investment decisions off anymore. It means that we can kind of therefore see a spurring of domestic and international growth. So as a result of all of that, in isolation, those features will mean that equity markets are better supported. But at the same time, those are not the only two things that matter in the global ecosystem right now, right? The dominant story globally has been AI, and we continue to be buyers of the AI trade. We continue to think that this is something that will power, the broader economy, in particular power the US economy over the course of the coming 6 to 12 months. So, I think you're right to say that those elements, trade and international conflict easing, will be something that the markets look on favorably. But there are other things that the market's looking at too, such as the AI trade, such as valuations of some of those companies, the kind of the path of future earnings. And while we remain positive, I think we should be aware that the markets have had at various stages this year different narratives on that too. So yes, a positive from this, but more broadly, this is an environment, what makes it so interesting and fascinating environment, where there are so many dominant market narratives that kind of come to the forefront and then go to the background, that it's not just a story of those two things that will affect global equity sentiment.
Vivek Paul, it was a pleasure talking to you today. That was Vivek Paul, of Global Head of Portfolio Research at BlackRock Investment Institute. Thank you very much for joining us today, Vivek, and wishing you a very happy New Year.
Thank you so much, and to you.